Right now, most investors are building their strategies in complete isolation, while a massive macroeconomic force is rolling in right behind them. If you trade stocks, you are likely calculating NVIDIA's PE ratio. If you trade crypto, you are tracking daily Bitcoin ETF inflows. Meanwhile, for the last 18 months, the financial media has promised a soft landing, but your actual grocery bills and mortgage rates show a significant gap between those headlines and your reality. To see what's actually happening, we have to look past the chaotic noise on the left. We're going to focus on this smooth four-stage wave, the global business cycle, to understand where capital is likely to flow in 2026. The strategy of buying every dip worked before 2024 because money was practically free. Applying that same assumption today, with the cost of capital sitting this high, breaks the math behind those infinite growth models. Mistaking a late-cycle peak for a temporary dip can leave an investor fully committed just as liquidity begins to pull back, often leaving them with no available cash when the market finally resets. Economic environments do not simply move up or down. They operate in distinct seasons, and the strategy that works in one can be a liability in the next. The cycle begins with the expansion phase. Growth is high, inflation is low, carrying tech stocks and crypto higher. Now look at the crest. In this late cycle peak, growth flattens, but inflation stays sticky, forcing central banks to pause rate hikes. This phase creates a false sense of security. Tech valuations hit record highs, while average consumers exhaust their credit. Then comes the contraction. As the slope points downward, unemployment ticks up, and systemic liquidity rapidly drains from the market. When liquidity vanishes, heavily indebted investors face margin calls, forced to sell assets at the worst possible time. Finally, the cycle hits the trough. This accumulation zone offers the best risk-to-reward ratio for those who preserved their capital. If you ignore which season we are in, you aren't executing a strategy. You are gambling that the tide will never go out. Let's look at the objective data for early 2026. The Federal Reserve is holding interest rates at 3.75, moving independently, snapping together in lockstep, because both react to the same lack of cash. Assets that rely on cheap debt to fund their growth lose all their diversification benefits when that debt remains expensive. They stop acting like independent investments and become identical proxies for systemic liquidity. When the cycle shifts into contraction, holding a basket of high-growth assets doesn't provide safety. Instead, it leads to simultaneous losses across your entire portfolio. You face a choice between sticking to your current asset-specific strategy or adopting a macro rotation framework. This matrix lays out two paths. Column A is the micro-silo approach, holding high-growth tech and altcoins based on individual narratives despite macro shifts. The trade-off for strategy A is massive exposure to liquidity proxies. When contraction hits, those assets suffer because the systemic cash needed to prop them up vanishes. Strategy B, the macro rotation, requires shifting capital out of speculative promises and into companies with proven real-world cash flows. The advantage here is downside protection. While the broader market faces a squeeze, these defensive assets are designed to maintain baseline profitability. However, strategy B has a psychological cost. These are boring assets. If the peak phase lasts longer than expected, you will see other traders making higher short-term gains while you wait. You have to decide what your priority is, chasing short-term FOMO or prioritizing the survival of your capital through a full cycle. To safely navigate an economic contraction, a portfolio needs to move from aggressive risk-taking into a more defensive structure. Step 1 is the defensive pivot. I am allocating 40% of my portfolio to high-quality growth sectors like healthcare and consumer staples, sectors that historically provide essential services regardless of the economic climate. Step 2 is the crypto barbell strategy. I am treating Bitcoin strictly as a macro hedge, moving away from speculative altcoin narratives that are highly sensitive to liquidity drains. This chart maps asset resilience. For 2026, I look for assets generating tangible revenue, moving them to the resilient bottom right quadrant. The final step is the cash king rule. I keep 30% in liquid stablecoins as a strategic reserve. Holding cash has a cost, inflation, but that cost is a trade-off for having the dry powder, ready to buy assets when the market finally hits its lowest point and others are suddenly forced to sell. Ignoring this data means acting like a gambler, trying to swim against a tide that is clearly moving out. Acting as a macro strategist means using this structure as a vehicle to get through the transition with your capital intact. I track the specific leading indicators for these rotations every month. You can access that breakdown through the link in the description to inform your own positioning. Lasting wealth isn't built by finding a hidden gem at the highest peak. It's built by having the liquid capital to buy the market when the cycle finally hits the trough.